Hello, Savvy Investor. Thank you for joining us for this video series on how to increase the return on investment on your current investment portfolios. So before we get into the specific strategies on how to increase your rate of return, the very first thing we need to understand is what is your current rate of return on that specific investment. The example we're going to use today is a single family home residential investment, but this goes for any investment platform that you're currently investing in, is understanding what is your current rate of return. As you guys know, by following my strategy, even though I like to invest in all different platforms, my number one favorite type of investment is residential real estate or real estate in general. So we're going to use this example today in calculating what is your current rate of return. It surprises me how many times you as investors come to, and talk to me about your current investments, and I ask the question, what is your current rate of return? And you don't know the answer. You tell me a dollar figure, and it really cracks me up. A lot of times what you share with me is, oh, I'm making enough money off that investment to pay this car payment. And that really isn't the strategy of building long-term wealth. What I want to know is what is the return on investment in a percentage from the amount of money you put in versus the amount of money you're getting back, and then creating new money rules for that money as it's coming back in of how are we reinvesting that money to increase your long-term net worth and passive income. So let me share this with you, and we're going to walk through a strategy or the sequence of how to calculate your current rate of return. By the way, this spreadsheet is, I've made it available on our website. You can click it there on the Savvy Agent or Savvy Investor website next to this video. So you can use this master template here. I'll show you what the master template looks like real quickly. And you can just fill in your own information, and the formulas will kick out what your rate of return is on those investments. But let's walk through this. This is an investment property I bought in 2010. Great timing. And it was a small 3-bedroom, 2-bath house. And it's been a great return on investment for me ever since I bought it. But let's walk through this. I do this at the end of every year just to make sure I understand what the rate of return on each investment vehicle I have is. So this was done on 12/31/20. And I come down and I outline, okay, what was my cash outlay at the time of purchase, which in this scenario was $22,211. The current value of this property is $235,000. So I take that opportunity at the end of the year to calculate what is the actual market value of the property. Now, for me, I tend to be a little conservative in this, particularly in a very robust market like this, where a lot of times you're seeing double-digit appreciation. I'll actually look at what I could sell it for on the market, and I'll pull it back just a little bit, just because I am more of a conservative investor, but that will be what you feel comfortable doing. But current value of that property, I put at 235. Realistically, if I put it on the market today, I could probably sell it for 255-ish. Value of the property last year was 213,000. So you can see I saw pretty good appreciation this last year, which the reason that it's important to put both those numbers in is I'm going to calculate the return on investment from a cash basis standpoint, but I'm also going to look at the effective return on investment, which how does this investment affect my net worth statement? Now, the difference between that cash on cash return versus the effective return on investment is the cash on cash return is giving me or showing me the cash I'm actually getting back that I get to turn around and immediately use, where the effective return on investment takes that cash plus how is it affecting my net worth on a net worth or balance statement. And that's the overall return, both in the physical cash and the appreciation. So if we look at this, just kind of walk through this, the annual gross revenue on this property is $14,700. These numbers are annual here in yellow. We'll automatically calculate your per month basis here on the next row over. Insurance on this property, $1,600 a year, minus the management fees, $554 annually. That was the insurance was $545. The management fees, $1,470 to the property management company. HOA 1,020, maintenance. Now this one you can change a little bit. My general rule is it's about 3 or 4% per year of the annual rent, unless you have held a property long enough that you start to understand, okay, this property may tend to take a little bit more or a little bit less based on that property. Or if it's an older property, you're probably thinking through like, okay, are there a water heater coming up or a HVAC that needs to be replaced? You might need to start bumping that number up. In this scenario, I put $100 a month, which is probably a little high for this property. But again, I tend to be a little conservative in those numbers. So running this through, taking my gross revenue minus my expenses gives me my net operating income. Now, it's important to calculate your net operating income prior to subtracting out any debt servicing on the property. And one of the reasons you do this is a lot of us talk about cap rates, what properties are changing for in a cap rate perspective. And cap rates use net operating income to be calculated. So get in the habit, even though we're not talking about cap rates in this scenario, get in the habit of calculating your net operating income prior to subtracting out your debt servicing of the property. So you can see the net operating income is $8,865 minus mortgage expense. Now notice here, I put in parentheses principal and interest only. So if you've got a loan through a traditional lending source, more than likely every month you're paying a certain amount that goes towards, a portion of it goes towards principal, a portion of it goes towards interest, and a portion of it is going into an escrow account, which is going to be applied towards your taxes and things like that, or HOA or things like that, depending on how the loan is set up. But you can see we already subtracted that out above. So here you need to pull up your mortgage statement and see if you're paying $1,200 a month. You need to understand how much of that is going to work towards principal, because the principal is paying down your amount owed, which is going to be taken into consideration for your effective return on investment, which we're going to talk about below. So this is principal and interest only. Don't just take your mortgage payment times 12. Now this one is a little bit interesting because my mortgage payment on this property is only $155 a month, which this is an interest only, and it was a HELOC, it was a home equity line that I used to buy this property in 2010 because I was maxed out of the number of loans that I could take that were being sold on the secondary market. So I'm generally against using a HELOC to buy a property like this, particularly because generally it's associated with a variable interest rate. But in this scenario, it was a low enough loan amount of $50,000 that if the interest rates doubled tomorrow, I could walk in and just pay it off. So it wasn't that much of a risk associated with it. So this one's a little bit different, but I wanted to use it as an example that you can see that my before tax cash flow is $7,000 annually on this property. And this is where I can start calculating what my return on investment is. So my before tax cash flow divided by cash outlay at the time of purchase, this is my cash on cash return, is 31.53%. So I take this $7,000 divided by the $22,211 that I put into the property at the beginning, and my return on this investment is 31.538. Now, that is an incredible number. And we also got to understand that markets have cycles, and within these cycles are seasons of acceptable return on investment. It is very, very hard in a market where things are selling for top dollar to capitalize and get this type of return on investment. So in our upcoming conversations, we're going to be talking about what should be an acceptable rate of return based on what is going on in the marketplace. I would be foolish to go buy a property that was giving me a 3 or 4% cash on cash return on investment if I could take that same capital and go invest it in something that was giving me 12 or 15%. But if that 12 or 15% isn't available, I'm much better to buy a property that is giving me a 6, 7% cash on cash return, other than letting it sit in the bank and not even keep up with inflation, particularly where inflation is showing up in such a rigid way right now. So our exercise does not end here. It's important for us then to go say we have to add back in our before tax cash flow. So the appreciation gained this year. So we look at this, the current value of the property at $235 minus what it was a year ago. We increased the value of the property by $22,000 by doing nothing this year. This is one of the reasons I love investing in real estate is the fact that even though I leveraged part of the acquisition of this property, I get to participate in the full value of the property appreciating, not just what portion I put the cash down on. So you can see that my net worth increased by $22,000 just in the form of appreciation, plus adding back in this $7,000 in before tax cash flow. In this scenario, this next yellow line would be adding in if my mortgage payment was paying down any principal. So if I was paying $1,000 a month in a mortgage payment and $400 of that a month was being applied towards principal, I'd take 400 times 12 and I would add that in here. And I'll show you another example of this in a second. But in this scenario where this is a interest only HELOC, none of that money is being applied towards principal. So I put 0 there. So this shows now that my total gain on this property per year, both in cash on cash return and in gains from appreciation or principal pay down, is $29,000, $29,005. And then I take that number divided by my total cash outlay at the beginning, and you can see my effective return on investment is 131% per annum in this specific investment. Now, let me show you another quick example before you walk through and do this. This is another property that I did that exact same exercise on. You can see that this property, I put $36,000 down. The current value of the property is $355,000. Value of the property last year was $325,000. My gross annual revenue from rents is $19,800 minus taxes, minus insurance, minus HOA, management fees, minus HOA, minus maintenance. Notice I put in a minus other. If there's other things that you're obligated for and taking care of the property, such as landscaping or pool maintenance or something like that the tenant's not taking care of, you could add that in here. And we can see that the net operating income on this property is $12,705. Now, notice here, I put in the minus mortgage expenses. This is principal and interest only. I've subtracted out any money being held for the escrow account and $6,632, which gives me a before tax cash flow of $6,073. If I take that $6,073 divided by the $36,000 down, I put my cash on cash return on this investment is 16.869%. Still a very respectable return on investment. Plus the appreciation from this year, taking the 355 minus the 325, I increased my net worth just in appreciation by $29,000 this year. And if I look down, add back in the 6,073 plus principal made. So going back to the example, the previous example I showed you is I wasn't paying down principal on an annual basis based on that loan type. Well, this loan type, a portion of that loan payment every month is paying down my principal, which you can see this last year, I paid it down $2,310. The longer you have the loan, as a percentage of your payment, a bigger portion of that will be paying down principal. This shows my total gain on this property this last year was $37,695. Taking that number divided by the 36% is an effective return on investment of 105%. Now, keep in mind, these are two examples of properties I bought at the prime time in the market in 2010, 2011-ish, where I was able to get these properties at a very advantageous price. The things I'm buying today are not giving me these types of returns, but it still is a significant return, which in future episodes of this same series, I'll kind of walk you through some examples. So one of the things I'm going to walk you through in the next one of the next videos is this exact same property is choosing to refinance it, which means that my total increase on return may decrease, but I'll get the cash back out of it that I put in, which my cash on cash return is going to go significantly up because I won't have any cash in the property, but my overall return, the way it overall affects my net worth may decrease a little bit, but it's because it's creating another opportunity for me that between them is taking a big step forward and pushing my net worth forward. So this is where we become great stewards of understanding our rate of return, our required rate of return, and then we can start being strategic in how our assets can work together to create more opportunities within our same portfolio to keep pushing that forward. The idea is each of these investments are working independently to march forward. But if they're working together on the same overall war, if they understand how they're working together, then the whole portfolio moves forward at a much faster and strategic way. That is where the savviness comes into savvy investing. Thank you for being here for the first part of the video series, how to increase your rate of return. We'll start talking specific strategies in the next videos in the series. Be sure to download this and for your portfolio, walk through this and understand what is your current rate of return. And let's start talking strategy. Thanks. We'll see you next time.